I'd like to welcome Ed Lazear, former chair of the Council of Economic Advisors under George W. Bush. Ed, thank you for joining me this morning.
Good to see you, Rick.
Well, listen, I want to know what you think of the number. It shouldn't be surprising. It doesn't make it any less shocking. But I really want you to pay particularly close attention to the big jump that we saw in average hourly earnings month over month and year over year.
Absolutely.
Tell us your thoughts.
Absolutely. Well, let's start with the basic number, the 14.5% unemployment rate. That's obviously a staggering number. It just tells us that there's an enormous amount of pain out there. Unfortunately, there's actually more pain than is indicated by that number. As you know, Rick, those numbers are collected on about the 12th of the month. So since the 12th of the month, there have been a number of unemployed workers that have come in through the initial claims. We've seen that. So right now, we probably have about 40 million workers unemployed, which maps into an unemployment rate that's Great Depression level. So next month, I would expect to see the unemployment rate jumping considerably. And so we know that's where we are right now. That said, I want to come back to the points that you raised. There are a couple of numbers that I always look at. The one, that I like to follow is not the unemployment rate, but actually the employment rate. This time, that basically tells the same story. It's at an all-time low at 51%, dropped down 10 percentage points from where it was. Just to give you some perspective, it's about 7 percentage points below where it was during the 2009 recession, 2007-2009 recession. So these are obviously numbers that just are staggering. But let's come back to the point that you just talked about, which is the hours of work actually going up and wages going up. And you say, well, how could that possibly be? What I think that's actually a preview of the kind of recovery that we're going to have, because what that tells us is that firms are going to be using fewer and more highly paid workers and having each one of them work longer hours. Right now, part of that is created by the unemployment system. Because you can get unemployment insurance, it's better to lay off the workers, have them draw the money from the government, and have fewer workers on board. But I think that's going to actually persist during the recovery. So what we're going to see is the recovery will first see output grow, then we'll see employment grow, and then we'll see wages grow. That's typical in any recovery, but this one will be more pronounced.
Excellent. Now, Ed, we're going to switch gears here. I want to move into a different lane. We have two-year note yields right now around 11 basis points. We have 6-month bills around 13 basis points. So obviously, two-year notes are below 6-month bills. We have Fed fund futures depicting that from November 2020 on, we could have negative overnight Fed funds. Now, Jay Powell and company has said that, NIRP, negative interest rate policy, isn't in their crystal ball. But yet, it certainly seems as though traders and markets are pushing to see if the Fed has a response to some of these huge 24-hour drops in short-end rates. Your thoughts?
Well, I have two thoughts on that. First of all, if you look at the European experience, negative interest rates have not done a lot to stimulate those economies. You could say, well, it might have been worse had they not had negative interest rates, but there's just not a lot of evidence that that's done much. So I think the chairman is wise to be giving us forward guidance that that's not where he's going. I hope he doesn't go there. That said, I want to make clear that this is a continuum. When you're at zero interest rates, if you go 5 basis points below, you go from 0 to -5, that's not a major move. So this is a continuum. The one respect in which it is not a continuum is what does it signal to the market? What does it signal to the economy? What does it signal in terms of how the Fed is thinking about things? Some have said that it signals that the Fed is willing to do what it takes. I disagree with that. We already know the Fed is willing to do what it takes. What I think it signals is if they go negative, it essentially tells us that they are out of weapons. They basically have nothing else they can do. And my view of that is that that kind of move would actually create more uncertainty, create more investment distress, and I think it would actually go in a negative direction. So I don't think that's a good idea.
Now, Ed, we're almost out of time. I only have about a half a minute left, but I really want to know the answer to the next question. And that is, when I look at the stock market, had discussions this morning, Many believe it's doing much better than anything could possibly look regarding the economy a year or two down the road. My thought is, investors invest in stocks, but in order for those companies to make a profit, much of the economy and many workers have to be working and drawing a salary. Can you equate what you think about the future with where stocks are today?
Well, if you look at the stock market, it's down, depending on where you date it, it's down 10, 15%. So it's still down significantly. And if you think of that as a forecast of long-run GDP, if we thought that GDP would get back to, say, its February level within 6, 7, 8 quarters, that would not be inconsistent with what we're seeing in the stock market. We would take a year and a half hit, but from then on, we'd be back to where we were before.